Good evening and welcome to another episode of NightMarkets, where each week I'll be giving you my perspective on what's driving markets, as well as my view as a family office professional. My name is Jacobus Brink, the Chief Investment Officer and Head of Investment Research for South Africa at SFO. This week, markets celebrated the US economy possibly achieving a soft landing, as investors appears to celebrate positive news on both the inflation and the growth fronts, which helped stocks register a solid week of gains. Post the sell-off on August 5th, the tech-heavy Nasdaq Composite led the gains this week and concluded the week with a 12.24% increase from its intraday lows. NVIDIA, the leading manufacturer of artificial intelligence chips, experienced an exceptional week with an 18.93% increase. In the same vein, growth stocks significantly outperformed their value counterparts. But before we get into markets, let's just check in on the current situation in the Middle East. On Saturday, an Israeli airstrike in central Gaza resulted in the death of a number of Palestinians and the injury of dozens more. Israel issued fresh evacuation orders, citing Hamas rocket fire in the vicinity. The violence occurred prior to the anticipated arrival of U.S. Secretary of State Anthony Blinken in Israel on Sunday, and his meeting with Israeli Prime Minister Benjamin Netanyahu on Monday. This occurred in the context of intensified diplomatic efforts to reach a deal that would end the conflict between Israel and the militant Islamist group, as well as release Israeli hostages. And following 2 days of negotiations in Doha, U.S. President Joe Biden announced on Friday that an agreement was now within reach, despite cautioning that the negotiations were far from over. So let's jump into markets. So starting with the Americas, in the U.S., in spite of some declining labor market data, official economic data indicated that the consumer was maintaining its strength. The Commerce Department reported on Thursday that retail sales experienced a 1% increase in July, which was the most impressive performance we've seen in the past 18 months. The auto sector, which is notoriously volatile, experienced the most substantial gains in the data set. However, the increase was widespread and encompassed a 0.3% increase in sales at bars and restaurants, which is indicative of robust discretionary spending. Also, sentiment appeared to be bolstered by the inflation data that we saw earlier in the week. The Labour Department reported on Tuesday that the core prices paid by producers in July were unchanged, marking the conclusion of 3 months of consistent increases. On Wednesday, consumer price index inflation was also reported consistent with expectations, which served as a source of comfort for most investors. It is important to note, however, that the CPI's year-over-year increase was below 3% for the first time in over 3 years. Consequently, consumer discretionary equities also experienced a very good week, as Starbucks experienced a 24.5% increase in value on Tuesday, following the announcement that it would replace its CEO with the ex-CEO of Chipotle, who was instrumental in orchestrating a turnaround at the company. Similarly, Walmart also experienced a close to 7% increase on Thursday as a result of its earnings report, which exceeded consensus expectations. And additionally, the organization also astounded analysts by increasing its revenue and profit projections for the remainder of the year. So at the conclusion of the S&P earnings season, the aggregate earnings are estimated to have increased by 10.9% in the second quarter compared to the previous year. It will now also be the fastest pace of acceleration since the end of 2021. The yield on the benchmark 10-year Treasury note decreased through most of the week on the back of the benign inflation data, but jumped on Thursday morning following the release of the very strong retail sales data. All the indices ended the week substantially higher, with the Dow Jones Industrial Average up by more than 2%, the S&P 500 up by more than 4%, and the Nasdaq ending higher by 5.5% during the week. Then moving across the pond to the Eurozone and the United Kingdom, the Eurozone economy expanded sequentially by 0.3% in the second quarter, which is very much consistent with the rate of growth that we observed in the first quarter. An unexpected contraction in Germany was, however, counterbalanced by GDP growth in France, Italy, as well as in Spain. Nevertheless, despite the positive growth data, industrial production experienced a 0.1% decline in June, which was less than the consensus forecast of a 0.5% increase. The survey of purchasing managers also indicated that business activity had also stagnated in July. Nevertheless, the labour market continues to be very resilient, as we saw employment increase by 0.2% sequentially in the second quarter. Looking at the United Kingdom in July, the headline inflation number increased from 2% in June to 2.2%. The financial markets have priced in a higher probability of interest rate decreases later in this year as a result of the slower than anticipated growth in services prices, which was a concern for policymakers initially. The economy also maintained its resilience during the 3 months that concluded in June, following a robust recovery in the first quarter, following the recession of the previous year. The GDP increased by 0.6% on a sequential basis. In comparison to the same period last year, the average weekly earnings growth, excluding bonuses, also increased by 5.4% in the 3 months through June. This represents the lowest annual increase in nearly 2 years. In July, monthly retail sales volumes also experienced a 0.5% sequential increase, following a 0.9% decrease in July. And then looking at the markets in local currency terms, the Pan-European Stocks Europe 600 index also ended 2.5% higher as hopes grew for another round of interest rate cuts as early as September by the ECB. And then further afield in the Asia-Pacific region, Japan's stock markets experienced a robust recovery during a holiday-shortened week. The Nikkei 225 index was up 8.7%, while the broader Topix index also increased by 7.9%. The yen was once again the culprit, suffering a decline in value against the dollar. It fell from around 146 the previous week to the high at 148 this week. This development also benefited Japan's exporters. Japan's GDP also expanded more than anticipated in the second quarter of the year, providing additional support to the local market. The yield in the 10-year Japanese government bond index increased slightly from 0.86% to 0.88% in the fixed income markets at the end of the previous week. Following the Deputy Governor of the Bank of Japan's recent declaration that the central bank will not raise rates during periods of market instability, we have seen some dampening in volatility in the bond market in Japan. On the back of this, many market participants now reduced their expectations for additional rate rises this year as a result of the significant volatility that ensued when the Bank of Japan raised rates in July. In the second quarter of the year, Japan's economy experienced a robust revival, expanding by 0.8% quarter over quarter, and this surpassed expectations of 0.5%, and also reversed the 0.6% contraction recorded in the first quarter. The economy expanded by 3.1% on an annualized basis, which was higher than the consensus estimate of 2.1%, and also followed a contraction of 2.3% in the first quarter. We saw a robust increase in private consumption and a resurgence in business investment, as these were the primary contributors to the rebound. And then moving to China, investor sentiment was largely unaffected by weaker than anticipated economic activity, also resulting in a rise in Chinese equities. In July, industrial production increased by a less than expected 5.1% from the previous year, a decrease from the 5.3% number we saw in June, and was partially attributed to reduced auto sales. In July, retail sales increased by a more substantial 2.7% from the previous year, surpassing the anticipated 2% increase we saw in June. Another positive was fixed asset investment that increased by 3.6% from the previous year in the January to July period, which was below expectations but was still a solid number. According to China's Statistics Bureau, new home prices in 70 cities decreased by 0.7% in July, which was consistent with the tempo of declines in the previous 2 months and represented the 13th consecutive monthly decline. Although data indicated that the government's property rescue package, which was implemented in May, has stimulated demand in some of the major cities, purchasing interest in smaller communities has remained subdued. And in shrugging off most of the negative economic news, the Shanghai Composite Index gained 0.6%, while the blue chip CSI 300 added 0.42%. In Hong Kong, the benchmark Hang Seng Index was also up 1.9%. And then moving back home, locally, the only real market-moving news on the week was the unemployment rate. The unemployment rate in South Africa experienced an unexpected increase in the second quarter, reaching its highest level since 2022. This increase was primarily due to job losses in the commerce and agriculture sector. Data released by Statistics South Africa on Tuesday indicates that the unemployment rate increased to 33.5% in the 3 months through June, up from 32.9% in the previous quarter. Bloomberg surveyed 3 economists, and the median estimate was that the unemployment rate would actually decrease to 31.8%. The hotel and restaurant, as well as the wholesale trade sectors, accounted for the majority of the 111,000 employment losses in the trade industry during the second quarter. South Africa's unemployment rate, which currently stands at 8.4 million people, is amongst the highest in the world. The new governing alliance of the country, which was established following the 29 May elections, in which the African National Congress lost its majority for the first time since 1994, faces a significant challenge in this regard. Growth in the local economy has been abysmal over the last number of years, averaging only 1% over the past decade. And then just looking at the market performances, market performance was mostly driven by the risk-on global sentiment, and in line with global markets, the all-share index ended the week higher by 2.58%, with all of the sectors ending in the green, led by the financial sector, which jumped by more than 4.5%. The Rand is also currently experiencing a winning streak that we've not seen in 13 years. The currency's 9th consecutive day of gains, which is frequently regarded as a predictor for the outlook of emerging markets, represents its longest stretch since January 2011 and a 5-week high on a closing basis, ending the week at 17.84 Rand to the US dollar. And then just looking at the week ahead, the future trajectory of the U.S. interest rate may become clearer this week when Federal Reserve Chair Powell addresses the central bank's annual Jackson Hole retreat. Prior to that, the Democratic National Convention will also kick off, and we'll see a slew of global PMI data that will provide some insight into the economic strength globally. Additionally, we'll see some inflation data out of Europe, which will also be a big focus. And energy markets are expected to remain volatile in the face of heightened geopolitical tensions. On the local front, we'll see the release of the latest CPI data on Wednesday. And then, as always, we'd like to end off with an interesting investment idea we discussed during the week. This week, we focused on the concept of volatility clustering. Although volatility has come down post the big spike we saw on the 5th of August, financial asset returns often exhibit large changes in prices, and these changes tend to result in persisting patterns. This, coupled with an increase of volatility typically seen as we head into the US election season, means we could see more extreme moves in markets on the upside and the downside. And I think it would serve investors well to focus on risk management in their investment decisions. Thank you for joining me for another episode of Night Markets. Financial markets close at 5 p.m. Night Markets open at 6 p.m. Let's start the conversation.